in the red. I guess no surprise, given the fact that we have seen such a tremendous rally in stocks in the last 6 or 8 months. Is oil the issue?
I think it could become an issue. I think that there are some shock waves that occurred in the oil markets that took the market by surprise. One of which is the fact that Mexico's oil company, Pemex, announced several weeks ago that their giant oil field, Cantarell, it's one of the 4 supergiants, is literally in a catastrophic decline and could be completely tapped out in the next 5 to 10 years. So I think the market's digesting this. I think that a new risk premium is being built into the price over tensions in Iran, and I think, and also speculators are thinking that there's no way that we're going to have 2 mild hurricane seasons in a row.
So you're saying you think that oil prices are going to continue moving higher?
I think, I think they're going to go higher. How high? I don't know. I don't know if we'll go back to the old summer highs of last year.
Right.
But I think
nobody really knows.
Nobody, yeah.
Ron, how much of a worry is this for the equity markets?
Well, Maria, Art Cashin of UBS has often said, if you've seen this movie before and you know how it ends, it's not as much of a problem for the market. I mean, crude got as high as $78 a barrel twice last summer, and we're still well below that, so 60 is fairly easy to digest. The movie that the market hasn't seen before involves not just the housing market, but the subprime residential mortgages that you talk about a lot, and those stocks are getting hit. And what a lot of people are starting to look at are the collateralized debt obligations, which have stuffed into them a lot of what the industry calls those subprime resis, and people are waiting to see if somebody blows up because they've taken in too many of those derivative-type products, and whether it causes a financial market problem.
Right, well, that's the point. I mean, what do you think, Ron? Because this, you would think that this could represent one of those disruptions for a market that has really been so resilient in the last 6 or 8 months.
And Maria, it's a double-edged sword. I mean, assuming that the problem remains contained and you don't get any sort of systemic risk because too many large speculators or too many large institutions own this paper where we see spreads widening out pretty dramatically, then it's okay. Also, don't forget, something like this keeps the Fed on the sidelines. I mean, you could talk a lot about inflation scares, but if you have a true blow-up in the subprime market, it keeps the Fed from raising rates, because if they did that, they'd create an even bigger problem that could get larger than they'd like to see.
So we've got a couple of housing-related reports coming out next week. Brian, certainly this is the story of the day. I mean, you've got oil being one of the big stories, but certainly the subprime fallout and the housing market is one of the other major stories. From your standpoint, what's the main catalyst for the market in the coming 6 months?
Well, I think the housing, I think the housing market is is probably the catalyst. My contacts are telling me that the supply of homes for sale that have been for sale 3 months, 6 months, is a lot higher than what's being reported. And if we get another big shock like we have this week, it could stall the market. I've been very bullish on the Dow since the summer. I've been very bullish on small caps, the Russell 2000. I hope that this doesn't dampen the bull market heading into the spring.
Well, we've got the mortgage applications number released on Wednesday. We've got housing data coming out on Tuesday, and the Chicago Purchasing Managers Index coming out on Wednesday, which is always also something that people focus on. We're on the ISM Index. What do you expect to get from the economy numbers coming out in the week ahead?
Well, Maria, the economy is about 14% or so manufacturing, and we know that has softened considerably. We've seen that data over the last couple of months. 2 out of 3 months, I believe, have been below 50 for the ISM. So the Fed has noted that there's weakness in manufacturing. We are largely a service economy where there's still a great deal of strength. But, when you take into account all these, potential disruptions, the economy is fine. And don't forget, the market hasn't had a big correction. It could correct off a scare involving subprime mortgages. We saw that with long-term capital in '98. We saw with Asia in 1997. If the Fed were to step in, that's usually the catalyst for a buying opportunity after you have a short, sharp correction that kind of shakes the tree a little bit.
All right, we'll leave it there, gentlemen. Have a great weekend, and thanks so much.
Thank you.
We appreciate it.